Hey, this is Morawski. I'm calling to check in. Also, do you know when they'll be calling for my spouse? All right, hi everybody. How you doing? This is Mike, your host of Insider Secrets. And Insider Secrets is brought to you by My Core Intentions. So, the question I always ask is, have you been thinking about your intentions? Have you really been developing your why and thinking about what you're doing and the path that you're taking in your real estate investing? If you're looking for some direction and you're looking for some guidance and help, give us a call. My Core Intentions is ready to help you discover your why, help you build your business, and live a lot more balanced lifestyle. We know that in this industry, and we're going to talk to somebody today who is very busy in the marketplace, and we can get out of balance a lot. So what we want to try and do is see what it's going to take for us to balance our life a little bit more. And if we can help you do that, give us a call. But let me introduce you today to my friend and real estate investor, Lane Kawaoka. And Lane is a seasoned real estate investor who resides in Honolulu, Hawaii. Today, he's in Dallas looking at deals, but he lives in Honolulu with his wife and their dog, Panda. Lane's a seasoned real estate investor with a very impressive history. He's a licensed professional with a master's degree in civil engineering and an emphasis in construction management. He's got a bachelor's in industrial engineering, and both those degrees are from the University of Washington. As an engineer, Lane has managed over $230 million of capital construction projects in both the public and private sector. Aside from his day job, he controls 7 multifamily or manufactured home parks and 16 apartment buildings and 1 assisted living facility, for a total of 3,000 units in 8 different U.S. markets. Lane's passion project is simplypassivecashflow.com. It's a top 50 investing podcast and an online learning resource in passive real estate investing. Working as a high-paid professional in corporate America and frustrated by traditional wealth-building dogma, Lane was compelled to inspire and mentor other working professionals on how to do real estate investing and build their own portfolios. Lane urges other working professionals just get started by utilizing their highest and best use, their day job, to save for that 20% down payment for a conventional loan to acquire a single-family rental home. The simple passive cash flow method is to only buy investments with a healthy cash buffer to withstand a downturn in the market. So I think we're going to get some good information from Lane today. Lane's gotten so much appreciation from his work via his kind audience. In addition to mentoring, Lane also partners with beginning investors who want to build their portfolio but are too busy to handle direct investments. Here we are back to talking about the balance in your lifestyle, right? He uses his engineering mind, investing knowledge, and his network to crowdsource due diligence through 3,100 members in his Deal Pipeline Club. Together, they have placed over $24 million worth of capital to acquire $215 million in total real estate. So hopefully today we're going to be able to get Lane to talk about some of this strategy, some of his focus, and the market conditions today and where he sees the market going in the next few months. So Lane, I want to welcome you to the show, and I want to ask you to say hi to our investors and just describe to us in one word who you are and your investment strategy.
Just one word. Well, passive. I try to be as much passive as I can be, buy things that cash flow.
So passive investing, passive cash flow. That's good. That's going to make for a very good conversation, because a lot of investors that we have on the show, I know, are active and they have their hands in a number of deals and, are being busy. So what I'd like you to do is I kind of gave a pretty good backstory or introduction of you, but why don't you tell us about that backstory a little bit and what really intrigued you in real estate investing and how you wound up getting into it?
Yeah, I mean, my story is just like a lot of, folks that went to college. A lot of us were brainwashed as kids to go to school, get a good job. For some reason, I was good at math and science when I was 8 or 9, so that was on the track to being an engineer. So that's what I did. Graduated from college, worked as a construction supervisor, and I didn't like my job. For a lot of guys, that's going out in the field, checking up on cured concrete, working with like the staff, doing job briefings and stuff like that. It's not fun. It's cold. It's long days, and I was still on the path of the normal financial dogma, which is to go buy your own primary residence. So that's what I did. But because I was never home, I just decided to rent it out, and that was where I caught the bug. The rents were 2,200 a month, and the mortgage payment was 1,600. So I didn't know anything about the rent to value ratio or 50% rules or any of these kind of things that a lot of us know today. I just knew I was cash flowing a few $100, actually 500 or 600 bucks back then on that property, and that was a lot of beer money to me back then. But I knew that was my ticket out of the rat race. You know.
So that's a big word, right? Is the rat race. We all spin our wheels on that daily, working every day, trying to figure out what to do, and how do we get out of it? And it sounds like you kind of started to do that just by accident almost.
Yeah, I mean, I was gonna buy that first property and pay it off. Maybe got a 30-year mortgage on it. Was gonna try and pay it off in 20 years, and I thought that was gonna be my way to financial freedom. And yeah, that is one way of doing it, but that's like kind of the slow and low. You're just growing your money by like 3 or 5% every year. I'm an engineer. I can do my own math.
Right.
Um, it's the slow way of doing it. But when you're investing in real estate, and if you're effectively leveraging the equity you have, you should be growing your money 20, 30% year after year after year after year.
Yeah. Well, what's interesting is, 3 to 5% in the bank today would be good money. It's not like that today, though. It's kind of funny, but hey, you know what? So a lot of our listeners on the line are probably active investors and really might not even understand the difference between active investing and passive investing. Why don't you tell them your philosophy behind active and passive investing, and why one is better than the other? Your opinion, of course, right?
Yeah, yeah. I mean, just my opinion here. And look, I came from, I was working professional. I made a pretty good salary. A lot of my investors are doctors, lawyers, engineers, accountants, and make well over 6 figures a year. Um, a lot of those guys are. It all comes down to, like you said in the beginning, what's your highest and best use? For a lot of people, it's at their day job, making money so they can invest passively. And yeah, they may not be doing all these crazy burrs, finding these tax lien distressed properties, or being very active hands-on, putting sweat equity in, but their highest best use is building that initial capital. And at the end of the day, this is real estate investing. You need money to invest. If you don't have money, you got a money problem. And that's where I believe the active investing comes in. You got to generate capital, but at some point, you, up to that point, you're trading your time for money, just like a day job. But for a lot of investors, myself included, I'm kind of getting up to this stage, but where time is more valuable than money. You don't need to get those cutting, edge returns, those high returns that are very sexy. It's more about time, how little bit of sweat equity you put in to get that.
Hmm. Yeah, because time is one of those commodities that we never get back, right? Every second, every minute that clicks by.
Right. And yeah, everybody says, yeah, of course you want passive income, right? Everybody preaches it, even like all the shysters out there trying to sell infomercial products.
Right,
But look, the way I say it, you need money first, dude. Right?
right.
You got to have at least $250,000 to $500,000 to hit that critical mass at the very least. I would say, I would make even the argument that you need probably about 1 million or plus to be truly passive.
So it makes a lot of sense in the beginning to be an active investor, to build that portfolio, to build your wealth so that you can actively invest. Now, I've heard of opportunities out there where you don't need $250,000 to invest in them, and they exist, right? But you still need a good chunk of money because you don't want to put all your money in it anyhow.
Right,
Right.
right. Most of the syndication deals that I go into, the minimums are like 50,000. But no syndicator in their right mind should take your $50,000 if your net worth is under 200,000. That's like a quarter of your net worth. They should even take your money if that's 10%
So
of your net
what's a
worth.
syndicator? So I live in Chicago. You kind of have to be careful sometimes when you talk about the syndicate, right? But what's a syndicator in the real estate business?
Yeah, it's not the Commission Impossible syndicate of a crime syndicate. But so syndication is just a term you use to pull money together to go into a larger project. And it can be buying an apartment building, it can be developing a new real estate property, it can be even pulling your money together to go buy a restaurant or go start a new brewery. Syndication is just a form of pulling money together, and when you're starting to do that and you're starting to bring in passive investors, you trigger securities law. So the feds get involved. So you have to follow all the SEC rulings for that, because obviously a lot of people have laundered and stolen a lot of money in the past. So now there's obviously a lot of bureaucracy around it.
Yeah.
But essentially, what a syndication does is it creates a situation where I like to use an analogy of an airplane. In the airplane, you have the cockpit with a few people, maybe just one person, but you have a team of guys up in the front flying the airplane. These are the guys who find the deal, they find the lending, they put the lending in the loans in their name. So now that the passive investors have to do that, they operate the deal, they find all the investors. And the LPs, the people who come and coach, they just invest their money and they get to go to sleep, just like how I did this morning when I came to Dallas. I didn't find the plane, I just paid my money and got on the plane.
So another word for syndication or for a syndicator is sponsor. How, if there's somebody listening today that says, this is my next move, or this is what I want to do, is be a passive investor, how do you choose a sponsor? What types of things do you want to look for in a sponsor to be able to choose the right one so that you're going to be secure that your money's going to be safe?
Here's how I do it when I'm looking for deals to invest. It's 50% the person and 50% the numbers. So, breaking that down, the person. I don't invest in a deal unless I know somebody personally that has put 50 grand with that guy. There's so many daisy chain deals out there done by a bunch of people who can put a nice PDF or PowerPoint presentation together. I will only invest if I know somebody personally that I have an organic relationship that doesn't have skin in the game or a dog in the fight, that's not going to get a paid a referral fee or marketing fee or whatever. That has actually invested with this team in the past. And I've been burned a couple times after I've gotten just a random referral. Oh, go work with these guys. And then, come to find out that the person who recommended them, they're not even an investor. They just happen to be wearing a suit that day and, at the local real estate club. And then going to the other side, not many passive investors can underwrite deals the right way. But that I luckily can do that, so I can kind of cut through the nonsense in a pitch deck and see what kind of assumptions that are being used in a deal to kind of spot check if I'm going to invest with the team. So that's how I do it. I go numbers first, and then I go to my network if somebody has worked with that sponsor in the past.
Mm-hmm. So let's say that you are comfortable with a sponsor and you got that 50% piece out of the way and you feel their character is good and you've been referred to them and you're happy with the referral. And what do you look for in the numbers itself when you start to dig into the financials on a particular property?
Yeah, so I'm going to put it into my own analyzer by myself. I'm going to pull the rent rolls and the profit and loss statement myself. Now, I'm saying that knowing that 95% of investors will not have access to that information to begin with. And if they did, they wouldn't know what to do with it anyway. But like I said, if you can analyze the deals, that's what you do. That's the best thing. And what you're also doing is you're also overlaying your assumptions, such as what is the reversion cap rate? What's the exit cap rate that's being used on the assumption of the deal? What is being assumed for rent increases per year? The annual escalator. What is being assumed for full occupancy? I'm overlaying my assumptions, right? Like I'm not assuming that property is going to be 95% occupied. I might think it's going to be 90 or 92% occupied. And then I'm going to use my assumptions and figure out what comes out at the bottom of the page in terms of numbers.
Yeah. Yeah. I'll never forget the first deal that I ever tried to analyze. And I don't mean try, I did analyze, but I took two legal pads and I filled two legal pads on a car ride back, 40-minute car ride back from a deal that we were looking at. And I analyzed it on by hand. And I said, man, I got to get somebody to write an Excel spreadsheet on this deal. So, but I never did buy that one because it wasn't right. But so I want to back up for a minute and talk again about the hands-on investor. So if you're a new investor or even a seasoned investor, how can an average real estate investor build a portfolio with little of their own time?
So my progression is I bought 11 single family homes on my own, and I got my net worth at least up to $500,000. At that point was when I pivoted where I sold the single family homes off because I realized single family homes just aren't scalable. I think a lot of your students are starting to, that's kind of why they find you, right? They realize that they come to that same realization that, that once the dream of getting 10 Fannie Mae, Freddie Mac loans in your name, was kind of the dream. And then someone gave you this crazy idea to go get 10 in your spouse's name so you have 20.
Yeah.
But then you wake up and you're like, 20 rental properties at a few $100 of cash flow each is only a measly $6,000 a month. Now I don't want to be facetious, but that's just not enough.
Yeah.
Right. And that's kind of a painful job to manage 20 to 30 houses, even if you have a property manager. It's just not scalable. And when I started to join different masterminds, I started to discover that these higher net worth accredited investors, they didn't own these rental properties outright. They were LPs in dozens of deals at $50,000, $100,000 positions. That was the way the affluent invest.
So it's interesting you bring that up because when you deal in scattered site housing, your economies of scale aren't there and you wind up losing money. It costs you more money to manage because you're running around to so many different places where, if you have and I always teach this is that if you have an apartment complex with 25 units in it, but you own 25 single family homes and you've got 25 roofs and 25 furnaces, it's costing you a lot more money, a lot more time than it is if you just have all that in one facility. So
exactly. And also to your point, just from a competition standpoint, there's so many mom and pop unsophisticated investors out there buying single family homes, duplexes, quads, 8plexes, 16plex. To me, I mean, they say you want to be around 50 or 60 units to get above, to get that property manager to sit in the office for you. But, after owning a few 50, 60 unit properties, to me, the big threshold is getting that handyman who drives around in the golf cart. And you don't get that until you get about 100, 120 units.
Right. Yeah. And it's like one of those things you kind of know that you bought a good deal when you bought a deal that it owns a couple golf carts that come with it,
Right. Other property. But I mean, let's
Right.
face it, that property manager is just a $30,000, $40,000 employee that's just going to play Candy Crush in that office all day long.
Yeah.
The real cost savings is going to come with that guy who drives that golf cart around, knocking out, plumbing jobs that you would pay a third party plumber $900. They knock that out on salary before lunchtime for you.
Right. So one of the things that we've talked about in the past is that there's three rules of investing, and those are income, leverage, and tangible value. Why don't you talk about those to our listeners a little bit on your concept behind those three rules?
Yeah, I mean, I run a mastermind of accredited investors, and they always come out these like wild off the wall investments, right? And I've first I always get frustrated because I'm like, dude, why would you just not want to go into something as simple as an apartment deal with value add? Like, what better sharp ratio risk adjusted return can you get? So I developed these short rules to like quickly nix why I don't think that the deal that they're presenting is a good deal. And that's just the best that I've discovered so far without just my head exploding for just some crazy deal that somebody finds. Like, so again, those three are, it needs to be leverageable, right? That's why we love real estate. It needs to be producing income and cash flow, right? That's how we all got into this business in the first place. Or at least that's what I did. So I can quit my stinking job and I can put food on the table today as opposed to hoping and praying I have money in the future in retirement. But the last thing, it's like, it's a fixed commodity. It's commodity. It's real. It's a real tangible asset. So when the Fed starts printing money like how they are with the stimulus, and they're going to inflate the money supply, well, I have a commodity. I have real value, and I lock in the debt, but I also have the real asset. So people will say, well, you know, gold bullions is a real asset, but I'm like, well, it doesn't produce income, and it's not really leverageable unless you do some mining stocks there. It's not all three. And then, you know, the kids, they always like this like Bitcoin stuff. I'm like, well, all right, maybe I'll give you the fact that it's a currency, it is crypto, but it doesn't produce income. You can't eat that thing.
Right.
It doesn't produce income. And technically there's a futures market, but man, that thing is up and down. But there's very rarely things that are, you know, like real estate that hit all three of those.
So one of the things I really like is the leverageability, right? And I always tell people, I say, look, if you're going to go buy $1 million worth of Google stock, you need $1 million. But if you want to go buy a $1 million piece of real estate, you only need 25%. You only need 250,000, and you can leverage the rest. And that's the power behind real estate, I think. And I think a lot of people kind of miss that sometimes because they don't understand that concept. And, you know, because of the leverage, we tend to be able to make a little bit more money at times as well. You know, can you talk about some of that math behind some of that philosophy and those strategies?
Yeah, I mean, you know, like, especially if you're investing in like stable assets, stabilized things, you know, you may not make a super high return on investment, maybe 10 to 20%. You know, it's not going to be like a venture capital startup. But I think also like what my more higher net worth accredited, especially the guys making over 350,000 a year with, you know, adjusted gross incomes in that highest tax bracket.
Yeah.
This game is almost more of a tax game. It kind of shifts. It's kind of like wealth building 3.0, right? First, we're talking earlier about going from active, whether you're working at a job or you're flipping houses or being very active, to getting more passive. But I think once you get to being, you know, the next step is going from passive to being investing smart, with being good with taxes, right? Using the real estate professional status to drive your income down to, you know, being smart when you pay taxes and when you don't.
So, you know, while we're talking about taxes for a minute, let's talk about, you know, tax consequences a little bit. Say, you know, you get in a deal, whether you're active or passive investor, and you're 5 years down the road and you're going to liquidate, and you liquidate out of that deal, you know, there's some tax consequences. You know, one of the things I always teach about is exit planning, right? Is we should plan this strategy when we buy the deal or go into the deal, so that we know what's going to happen in 5 years and how are we going to handle those tax consequences at that point. You want to talk about that a little bit?
Yeah, sure. I mean, yeah, you're right. You're completely right. When you exit a deal, you're gonna have to pay the capital gain on that. But you know, if you're exiting a deal, you should be more than happy that you probably made a pretty sweet return on your money, right?
Right.
So, but still, you have the taxes. So let's talk about that. Hopefully, this deal isn't the only deal you're in, right? I mean, we're talking about accredited investors here. Most of my guys are going into a few deals a year, and you know, if deals last maybe every 3 to 7 years, let's just call it 5 years on average. At any one time, you should be in about a couple dozen deals,
Right.
right? And you should be walking around with a pretty fat amount of passive losses that you got from the beginning of the deal, the first year, via the cost segregation and bonus depreciation. So as the deal exits, you reach out of that cost segregation bucket or the passive loss bucket and you pull out of that. So here's a good example. In 2018, I had sold 7 of my single family home rentals as I was transitioning more into the syndication world. I had a $200,000 capital gain, but I had about $300,000 or $400,000 of passive losses to offset that. So I used $200,000 of it, and it knocked it out completely. zero. And this concept of being a drug addict. I had Tommy Wright on my podcast. He's this term, not me. But you know, you want it's like a drug addict, and maybe people listening haven't been a drug addict, neither have I. But the way I'm thinking it works is you got to take as much drug so you don't go into withdrawals, right? Or you got to keep that good times rolling, right?
Okay.
So you always need to have enough passive losses in your bucket so you don't pay the tax man. And unfortunately, it kind of sounds like you're just kicking the cans down the road inevitably. But if you're keeping investing and keep increasing your cash flow, then what's the sense? It's the whole refinance till you die strategy. And at some point, maybe you have a big fender and you go, you lose, you don't have the passive losses to cover you. Well, you know what? Look how long you've delayed taxes. That's the whole game here. Time value of money, right? If you didn't have to pay the tax man for 5, 10, 15, 20 years, then awesome. Right? You just have to make it long enough till you die.
Yeah.
Right? But
Well,
even if you only make it halfway there, I mean, you got so much benefit by not paying the tax man.
so the other thing that you mentioned was not avoiding those taxes, but kicking the can down the road, right? And we can do that by refinancing if we're in an active deal, or if you're coming out of a passive deal or an active deal, you could do a 1031. Those are other options that kind of help you.
I really don't like 1031 exchanges though, right?
Okay, so
Because
that's interesting.
your basis always keeps going up in
Ah,
those deals, right? Or
okay.
your basis always stays the same, but your capital gain always keeps going up. And me personally, if I'm buying like a 1960s, 1970s property, I don't want to hold on to that property more than 10 or 20 years. No way, Jose. Because I mean, these, especially commercial buildings, these things, they have a serviceable life where at some point you just got to get rid of it. It's like a 1997 Honda Civic. Those things don't last forever,
Hey, that's what
right?
I
So,
drive. I'm kidding.
well, we all did at one time. That's why we're here, right?
Yeah, yeah.
Buy
So,
assets, not liabilities.
so that's interesting though. So, talk about your buying standards. When you're in Dallas today, you're looking at deals. Tell me what you're looking for. What are your buying standards?
Yeah, so I like to focus on stabilized deals. So that's defined from Fannie Mae, Freddie Mac as 90% occupied or more. So pretty decent running properties, partially so I can get the non-recourse lending, which initially that's what I couldn't understand. Why would the government give these sweet loans to these rich syndicators?
Hmm.
But hey, it's just what the government is doing, right? And they'll continue to do that because that's the only way that they can satisfy the workforce housing demands, as
Yeah,
opposed to turn into government housing.
interesting.
So, so non-recourse debt, 90% occupied. The biggest thing is I want some room to move the rents. So I want to buy a deal where it's at least $50 under market today.
Okay.
And if I want to put in new flooring, new appliances, nothing crazy, right? Maybe $3,000 to $6,000 a rehab per unit, but that can give me an additional $50 to $100 lift on the rents.
Okay.
So I'm looking, I guess I failed to mention B and A class type of properties in better areas. So B and A class areas. I'll do a class C building, but it needs to be in a better area. But pretty basic. I mean, I don't like the heavy value add and unstabilized properties. That's not in my buy box.
How about all metropolitan areas, or were you going to tertiary market?
Yeah, so secondary and tertiary markets, mostly in the south, southeast, following population growth and job growth. I don't know which of the two leads the other, but those are the two biggest factors I see.
Okay. Hopefully going in a positive direction on both of those, right?
Right, right.
Yeah.
I mean, a lot of times I personally think it doesn't matter what market you're in, as long as you're in an uptrending market where the population is going up. And of course, you're buying in better sub-market,
Yeah.
right? And make that very clear. You can be buying at a decent market, but you're trying to find the good sub-markets, right? Like Dallas has dozens of sub-markets
Yeah.
in Dallas.
Yeah. Yeah, I had a pretty big footprint in the Dallas market. I own about 2,700 units there, and the submarkets are really good. I like that market around Bedford and Hearst, Euless, that tri market there. It's a good market here. So one of the things that we've talked about too is that you have a 5% net worth investment uh, rule. Can you talk about that a little bit?
Yeah, I kind of give people are always looking for rules of thumb. So, how much should I invest in a deal? Well, not more than 5 or 10% of your net worth
Mm,
for beginners. And this is why, like, I mentioned like a guy who's $250,000 net worth or below has no business putting 50 grand into one deal.
sure.
It's just too much, right?
Yeah.
And then people are like, well, how can I invest? I'm like, yeah, you can't invest. Your net worth is too low, I mean, it took me 7 years to get up to 11 rentals myself to get my net worth up to a decent point.
Yeah.
This is not a get rich quick thing. It's a get
Nope.
rich surely thing.
Yeah, that's a great point, right? Is this isn't get rich quick, it's get rich over time. And I think that there's a strategy behind creating short-term cash flow and long-term wealth, right? And there's a gentle balance there that you can really build a lifestyle and build your portfolio as a result of that. Who does your property management?
Third party property management, I want nothing to do with that.
Okay, so do you use the same people all the time, or do you pick new ones based on the market you're in?
Usually different ones, but usually we'll go after guys that are more regionally um, located. So no national property managers and none of them that just have one little shop in a few submarkets or market. If
Okay.
that makes sense. So like guys who and they might work regionally over a few states. They have a decent size, but they're not big enough where I can't have a conversation with the upper management.
Okay. So one thing that would keep you away from a property management company. So what would turn you away from not using somebody?
Well, I think it's just like picking sponsors, just referrals, right? Like if it's not referred to me, I mean, it's cold. It's a cold referral.
Yeah,
I think
yeah, sure.
referrals mean so much, whether you're buying single family homes or apartments or working with a lender or an HVAC guy. Just don't go, whatever you do, go off referrals.
Yeah. All right. So one last question I have for you, but talk about using your retirement funds for investing. So specifically a 401k or some type of an IRA. How do you, as an investor, utilize those funds that you may have put aside?
Yeah, so I personally don't have any retirement funds because I mean I'm on the younger side of most investors. I am going to probably want to start eating that money before I'm 45. So to me, I don't want to lock my money up into any government sponsored retirement fund and be forced to take it out when I'm 60, 65. Who knows what that age is going to be? It's only going to get older.
Yeah.
But I also recommend that for most people, even if you are over the age of 40, 50, because first reason, taxes. You're going to pay taxes in the beginning or the end, one or the other. I personally would rather pay taxes on it today because my hunch is taxes will be going up in the future. I mean, how else are they going to pay for all these entitlement programs? And secondly, how else are they going to, or you're going to want to pay most conventional wisdom says that you're going to be in a lower tax bracket in the future, right? But not if you're a real estate investor. I'm going to be living large, man. I'm not having that. Was it 97 Civic anymore? No, we're all Bentley and Benz, and by that time, I don't have it yet.
Yeah.
But I'm gonna be top tax bracket for sure. So
Sure.
that's
Sure.
why I want to be paying it now. And the way the government works, the money in the retirement accounts they're probably number one potential revenue source. They can tweak the rules whenever they want to get at that revenue. So I want my money out.
Yeah. Yeah. Understandable. Well, Lane, I just want to thank you for being here today. Some great information. I'm sure that we've overloaded some brains on that are listening in today, which is okay because this is how we grow, right? We all learn by listening to other people and picking up new ideas. But if people want to get a hold of you or they want to listen in on your podcast, why don't you give them some information on how to do that?
Yeah, if you want to check out my podcast, it's on iTunes, Google Play, on Simple Passive Cash Flow is how to find it. My URL is simplepassivecashflow.com. You guys check out the first 12 podcasts, learn a little bit more about me. I'm totally willing to get on the phone with anybody. Email is Lane at simplepassivecashflow.com.
Okay, perfect. Well, thanks, Lane. It was really good talking to you again today. I hope you have some great success in Dallas there, and travel safe in the midst of this coronavirus and everything. Hopefully this is all going to be behind us soon here, and we'll be back to some kind of normalcy in the world, right?
Yeah, we got our masks here.
Yeah, everybody. All right. Well, thanks for listening in today, everybody. And I will definitely be listening for your call coming in. And if we can help you with anything or help you design your business plan or direction, whether you're actively investing or passively investing, give us a call. Look forward to talking to each of you soon. Have a great day.